Okay, everyone, thanks. First-time homebuyer programs. Thank you for joining today. Here we go. Most first-time homebuyers entering the market have very little savings and or very young or bad credit. And because of this, most banks found them too risky to lend to. To meet the need to help this very large and important group of homebuyers, government-sponsored entities such as Fannie Mae and Freddie Mac, and government departments such as the Federal Housing Administration, FHA, the United States Department of Agriculture, USDA, and the Veterans Administration, VA, developed loan programs with low to no down payment requirements and lower credit score requirements. If the banks also insured these loans with private mortgage insurance, whose premiums are paid by the borrower and claims payable to the lender or investor in case the loan defaults, then the investor would buy them and the bank wouldn't have to hold on to them. So banks jumped at the opportunity to close more loans. First-time homebuyers who do have a substantial down payment and good credit generally do not get these programs, as monthly payments can be higher due to higher rates and or the added mortgage insurance that's required when the down payment is less than 20%. The rules are standard from lender to lender because the entity that backs the loan sets the lending requirements. However, the rates and fees can differ from lender to lender due to the lender's appetite for them. So some lenders who want large volume from first-timers will price their loans more aggressively, or they'll run fee waivers or discounts to points. So the first program we're going to discuss here is the Fannie Mae Home Ready Loan Program. This program offers a low down payment, 3% down. The down payment can be a gift. Mortgage insurance is required if less than 20%. The amount of MI depends on the credit score and the down payment. Additional income for qualifying can come from rental income from a detached or attached accessory dwelling when purchasing a primary residence. Appraisers' estimates and or current lease agreement with the tenant are used to determine the amount that we can add. If borrowers need help qualifying, all borrowers do not need to reside in the property. For example, parents who won't be occupying the home can be a co-borrower to assist their children. There is required home buyers counseling, and there are income restrictions. So there's a max to how much the borrower can earn to qualify. And if you're negotiating with a seller to help the seller contribute towards the buyer's closing costs, they can, up to 3% if the down payment is less than 10%. If they put more of a down payment, the seller can actually contribute more. The next program is the Freddie Mac Home Possible Loan Program. Again, low down payment, minimum 3% down. The down payment can be gifted. Mortgage insurance is required if it's less than 20%. The amount of the mortgage insurance depends on credit score and down payment. Boarder income is allowed. It may be possible to use the rent from a boarder to qualify. Up to 30% of the total qualifying income can be used. Documentation for at least 9 of the most recent 12 months for shared residency and the boarder income must be provided. No FICO score. So provided at least one of the borrowers on the loan has a minimum of a 680 credit score, the income from another borrower with no score can still be eligible for qualifying. And all borrowers must occupy the subject property. There is a requirement for home buyers counseling, and again, income restrictions apply. So there's a max to the income that the group can earn. And seller contributions, again, 3% if the down payment is less than 10%. So seller can contribute towards closing costs and prepaids, which will help a buyer, obviously, who doesn't have that money, more options in closing their loan. Next program, this is the The oldest and for a while, very popular, now it's waning in its popularity, the FHA loan. The loan down payment is a minimum 3.5%. Mortgage insurance is assessed monthly for the life of the loan, and there's an upfront mortgage insurance premium that's collected, and it can be financed. It can also be paid by the seller. FHA allows a little bit more flexible underwriting. The main advantage is that the credit criteria is not as strict as for a conventional loan, which is sold to Fannie and Freddie. They also allow a higher debt-to-income ratio than conventional loans, meaning they require less income to qualify for the same loan amount compared to conventional. If a borrower has credit problems, someone who has that or lacks traditional credit may still get FHA financing. Minimum 600 credit score, and it's preferable if the last 2 years on the credit history, the most recent 2 years, meaning, is clean. If they have very young credit or no credit history, non-traditional credit can be established. We can use non-traditional trade lines such as a landlord, cable service, cell phone service, car insurance for at least 12 months, and they must be monthly payments. We can't use, for example, car insurance that is paid for every 6 months or every year, one payment that covers that period. It has to be a monthly payment. The FHA loan is assumable, so it is possible for someone not to have to obtain a new loan on their own. However, to assume an FHA loan, that person must still be able to meet the income requirements. They have to be able to afford the payment and therefore must supply their income documentation so that that could be approved. And a seller can contribute towards closing costs and prepaids, and for FHA, it's up to 6%. The next program is the USDA home loan. This is a very popular one because it's zero down payment, 100% financing, and there is an upfront mortgage insurance fee collected, which can also be financed as part of the loan, making the loan go over 100%. If there are credit problems, well, the minimum score for the program is 620, which is pretty low, in my opinion, for a 100% financing program. And preferably the most recent 2 years on the credit report is clean. So if there are any derogatories, that they be older than 2 years. It must be for a primary residence, and the property must be located in an eligible rural area as defined by the USDA. All borrowers must occupy the property. Only one-unit properties are allowed. That, of course, includes condos. There are income restrictions, and they change every year. I've yet to get the list for the state, but it's coming soon, I'm sure. And the seller contribution towards closing costs and prepaids, there is no limit. And lastly, the VA loan, which is available for veterans. Another zero down payment program, and this one, no mortgage insurance. Credit problems, there is a minimum credit score of 620. Again, with most recent 2-year history, preferably clean, to show that they are coming back from those derogatories. No leasehold properties are allowed for VA loans. Interest rates, they are better than conventional loan rates, so always good to first look at a VA loan for someone who has the benefit before any other kind of a loan. And the seller can contribute up to 4% of the purchase price towards closing costs and prepaids. Okay, so moving on to just a couple of common misconceptions for first-time homebuyer loans. This is based on experience in speaking with a lot of first-time homebuyers. First-time homebuyer loans are subsidized by the government and can give bigger loans than the applicant can actually afford. That is a misconception. The amount an applicant can qualify for is based on the debt ratio allowed for that program. For example, if the max debt ratio is 40% for the program, then the applicant's proposed monthly housing payment plus current monthly consumer debt can't exceed 40% of his gross monthly income. The first-time homebuyer program does not eliminate this requirement. Therefore, an applicant that earns $5,000 a month with no other debt would have $2,000 a month, which is 40%, for a proposed housing payment, which includes property taxes, homeowner's insurance or HOA dues if it's a condo, and mortgage insurance. And this would equate to about a $280,000 loan using a rate of about 4.25%. Honestly, a lot of first-time homebuyers I've spoken to, and individual being at that, will think that they could actually afford a much bigger loan than that. Unfortunately, it is based on the regular loan program underwriting guidelines across the board. First-time homebuyers are no different. Another misconception is the rate you're quoted is the rate you'll get. So the interest rate and the mortgage insurance premium depends on the credit score and the down payment amount. So estimations at time of pre-qualification or pre-approval are what's used. And once the home is found and the credit is pulled, rates can be confirmed. That's what I have for you guys today on first-time homebuyer programs. This information is going to be available to you in a couple of different ways. I am recording this. It will be posted in Elite's intranet as well as on my website at MidPac Loans. And I do want to give you guys an opportunity for any Q&A here too. You could either type it up or just blurt it out, and I'd be happy to answer any questions, or you can email me after the training's over. We got about 10 minutes. Anyone?
I have a question, Tony. I was talking to another lender that has a program for a 5% down with no PMI for first-time home buyers. Do you have anything like that?
5% down, no PMI. Is that a conforming loan below 679? Yes.
Yes, it is. It's conforming, but the interest rate's a little higher.
Mm-hmm.
But it still is cheaper for a first-time home buyer than paying PMI.
Here's what I think they're doing. This is very, very common, in which I can also do. The PMI is still there, but what's happening is the lender is paying for it through the rate. So they're offering a bump to the rate for, say, 1/4% or 3/8, depending on the credit score of the borrower. And they're using that bump to pay for the premium themselves. Therefore, there's no monthly mortgage insurance for the borrower. They're paying it through the higher loan payment based on the principal and interest determined by the rate that they were given. So yeah, that option is available. It can be done at any level of down payment up to or as low as 5%. Unfortunately, not below 5 to the 3% range. That isn't offered when you're putting down 3%. But yeah, that's out there. Many lenders can do that.
Okay, thank you.
Sure. Any other questions?
Tony, I'm gonna have a question for you after this call. It's pertaining to like a particular. It's kind of a weird question.
Yeah, no problem. Yeah, you want to email that to me, or just call me when you want?
Sure.
Okay, sounds good. Now, since well, let me give you one more opportunity to answer or ask a question. Say what I was going to say. Any more questions? Okay, guys. As a reminder, I want to let you know about the VIP agent program that MidPac Loans is offering with the support of Elite. So now for your borrowers, what's most important, I'm sure, is the promotion that helps them, and that is a $500 gift card after closing. These kinds of savings will change from time to time. For example, we may change it to an appraisal waiver or a discount towards the points or something. But for the next couple of months, it's going to be this gift card, Visa gift card after closing for $500. And for all of you agents that have signed up or will sign up on my website, excuse me. Of course, you get the benefit of 24-hour loan pre-approvals from time of referring your customer to me. If they're willing to go through the process, I'm happy to push that through for you guys. Return your phone calls within an hour. And handwritten thank you notes to your borrowers and to you and to your sellers agents. So please go to my website, check it out, sign up. It doesn't take more than a few seconds. And I'm also sending out a little thank you gift for doing that too. So at this point, any other questions before we end the call?
Nope.
Oh, okay. Well, thank you very much for calling in. I appreciate that. We're going to put this up online very soon, next couple of days. You guys have a great day. Much mahalo.
All right, Tony, I kind of have a long one. So if you don't mind just kind of staying on the phone call for like another 2 minutes, I don't want to.
Oh, yeah.
I don't want to waste everything. So I have a client who is trying to. So what he wants to do is he wants to buy a vacant lot, right? And then he wants to he sent me a link to these things called. It's kind of a funny concept, but they're called tiny homes. I don't really know if you know what they are. I think they're sort of like mobile homes that they drive out on a truck and they come in stock, showroom condition, and they just drop them off on your property, I guess.
Yeah. Right.
So he was asking me if you guys if I guess I knew anybody who structured loans for those sorts of homes.
Okay. I got a few questions for you first.
Yeah.
Is he looking at financing the land, or is he leasing the land for the home to put the home on there?
So he's looking into buying fee simple, land, like owning it.
Yeah. Okay. Owning the land. Okay. So I do have a loan program for buying vacant land. Okay. Mm-hmm. That's step one. Let me address this tiny home. So these tiny homes nationwide, they're being kind of associated with manufactured homes or mobile homes. That's essentially what they were in the past 30, 40 years. They're manufactured or mobile homes are actually homes the size of regular homes, but they're mobile. They can be moved around, and they're typically put on leasehold property, or if like this person does, people buy the land and they move a mobile home or manufactured home to it. Anyway, those programs are available in areas where there are a lot of manufactured homes and as comparables. That's the main thing here is, are there areas that have similar properties as the one you're buying or as the one you want to get a loan against? Because that's how you determine the value of the property. And that's how a lender will determine how much to loan you on it. Okay. So there aren't a lot of manufactured homes in Hawaii. And those that are around are spread out in different rural areas, not consolidated into neighborhood homes. So it's very hard for an appraiser to appraise them. But now that's different from a tiny home. Now this is actually pretty new. Within the past, 10 years, I guess they came out. A totally new type of property where it's tiny. It's it's like 400 square feet. These also have to be in a kind of a consolidated area, so that appraisers can watch what they sell for. Kind of determine how long it takes for one to go on the market and sell, and for how much, in order to say, well, this is how much it would be worth. So then a lender can say, well, this is how much we'll lend on it then. So there hasn't been any here. So unfortunately, he's going to have to buy his tiny home with cash. But the land can be purchased with financing. The land, I'm assuming, is going to be have the hookups for the electric and the water that he's going to need. So I have a program that he can get in with 25% down payment. The land, those loans are short-term loans. Maximum term is 3 years. So he does have to have a way to pay it off within 3 years. Typically, these land loans are used to buy homes that someone's going to build a house on, a regular house. And then when the house is done, they take out a 30-year mortgage against it, and they use that money to pay off the balance on the land loan that they used to get the land, right? But in this case, there's no loan program available yet for the tiny home. So once he brings his tiny home over and puts it on the land that he owns, he's not going to be able to get a loan against the tiny home to pay off the land balance. You know what I'm saying? So that's just not available yet. So that's something that he's going to have to consider. But I do have a program that'll help him get the land. He's just got to be able to figure out a way to pay off the balloon payment that's due in 3 years.
Okay, so it would be 25% down and then have to be paid off in 3 years, correct?
Yeah, that's right. Yeah.
Okay. All right. Well, thank you, Tony.
Yeah, I'm glad it helps.
All righty. I'm out of here. Peace.
Okay, take care, Nevin. Aloha. Any other questions? Okay, well, thank you for calling in. Thanks for joining, and have a great day.
Thank you.